those weeks when central banks take centre stage because the US Federal Reserve, the European Central Bank, and the Bank of Japan are all scheduled to make their latest policy decisions. In order, on Wednesday the 14th of June we have the US Federal Reserve. It's taken the Fed funds rate to 5.25% from 0.25% in just over a year and started to run a quantitative tightening or QT program to further withdraw monetary stimulus and shrink its balance sheet at the rate of $90 billion a month. After a blip when a series of regional banks went under in March, the Fed's balance sheet has so far shrunk by $550 billion or some 6% from its peak of $8.4 trillion. At this meeting, the markets are putting a 77% chance on no change in the Fed funds rate at 5.25%, but they then see a 65% chance of a hike in July and a similar chance of one in September to a peak of 5.75% before they're hoping maybe for the first cut in either November or December of this year. On Thursday the 15th, we then have the European Central Bank. President Christine Lagarde, late to the rate-rising party, has now jacked up the main refinancing rate to 3.75% from a low of 0 and also launched quantitative tightening at the rate of €15 billion a month. So far, the ECB's asset holdings have fallen by €1 trillion or 12% because the central bank has also called in cheap loans that it provided to banks. The ECB has also said it could reassess the pace of QT at this meeting. Now, EU inflation is down to 6.1% from a peak of 10.6%, but it's still 3 times the ECB's target, and Mademoiselle Lagarde has told markets to expect more rate rises. And then finally, on Friday the 16th, comes the Bank of Japan. New Governor Katsuo Ueda is a rare creature indeed among central bankers because he's not raised interest rates and nor has he abandoned Japan's quantitative and qualitative QQE scheme, whereby the Bank of Japan buys government bonds to cap the yield on the 10-year paper at 0.5%. No change in policy is expected this time either, even if inflation is now 3.5% and ahead of the 2% target. This ongoing monetary stimulus, by the way, could be one explanation, among many, for why the Nikkei 225 stock index continues to move higher and now trades at a 33-year high. On the corporate front, the news flow is quickening as we pull away from the run of bank holiday weekends in May. Names which may be worthy of further research include the following, although do remember that some of these dates could still be subject to change. Oxford Metrics on Monday the 12th, Ashtead, Oxford Instruments and Bellway on the 13th, Safestore and Severfield on the 14th, Halfords, GB Group, Marks Electrical, Burford Capital and Norcross on the 15th, and Tesco will round out the week with a trading update on Friday the 16th of June. But for all of those names, the company which could cause the biggest fuss in the coming week is Halma. The FTSE 100 firm is due to release full-year results at the end of March on Thursday the 15th of June. This will be the first set of figures presented by the new management team, Mark Ronchetti having taken over from long-standing Chief Executive Andrew Williams in April, and Steve Gunning, who replaced Mr. Ronchetti as Chief Financial Officer back in January. Halma provides a solution to a problem in that its hazard detection and life protection systems, locks and devices help companies meet regulatory requirements and keep staff, clients and customers safe. The mandatory nature of investment in this area creates consistent business flows and sticky customers, a combination which gives Halma a degree of pricing power, a useful thing during an inflationary environment. That in turn can mean high margins, good returns on capital, strong free cash flow, and a growing dividend for investors over the long term. And it's Halma's dividend track record which could again write a few headlines this week. The analyst consensus forecast is for a full-year payout of 20.4 pence per share, an increase of 8% on the 18.88 pence distribution for the year to March 2022. If this forecast is met, it would mean Halma's 44th consecutive increase in its annual dividend of more than 5% per share or more, and that's what would keep the Buckinghamshire firm in select company because there's an elite list of just 15 FTSE 100 firms that have managed to increase their annual dividend each and every year for the last 10 years, let alone the last 44. Besides the dividend, analysts will then look at the headline sales, operating margin, and pre-tax profit figures. On a headline basis, the consensus sales forecast is £1.8 billion. That's up 18% year on year, helped by acquisitions. The organic rate of progress may be of more interest, therefore, and at the first half stage, that was 9% on a constant currency basis. When it comes to the operating margin, Halma's management has a target of 18 to 22% on an adjusted basis over the long term. At the first half stage, the operating return on sales was 19.6%. And for pre-tax profit, analysts are looking for a 14% increase to £360 million from £278 million on an adjusted basis, while the statutory number seen coming in at £314 million. For the year just begun, if management feels able to give any guidance, consensus is looking for an 8% increase to £390 million on an adjusted basis. More strategically, watch out for updates on acquisitions, as Halma uses select purchases to supplement its organic rate of progress. In March's trading update, boss Mark Ronchetti revealed that Halma had made 6 acquisitions at a maximum cost of £264 million in its fiscal year to March 2023 at that point. The firm then bought FirePro just before the financial year ended March, and has kicked off the new financial year by snapping up Poland's Sewertronics for £36 million. Thank you for watching. I hope that you and your families are all in good health and good spirits, and I look forward to seeing you next time.